Hi, and welcome to another ERE podcast. I am Helen Mercer-Jones, and I am joined today by Hugh Spillane from DNA Financial Solutions. Hi, Hugh. Thank you for joining us.
Thank you so much. Appreciate being here.
We obviously deal with a lot of buy-to-let investors who are always asking us about mortgages and what's happening in the mortgage market. So do you want to start just by telling us a little bit about DNA Financial Solutions and what you do?
Yeah, absolutely. So thanks very much. I'm Hugh, the Chief Exec of the DNA Financial Solutions Group, and we are a full-service finance and insurance brokerage based in the north of England, but actually serving all property and locations around the UK, and for property investors in the most part from around the globe as well. A full-service agency with two offices, one in Halifax in West Yorkshire and one just outside Manchester as well.
Lovely, thank you. So we're always getting asked questions from our investors, and we've had a few that recently that have been sent through to us. So first of all, can we sort of kick off by asking, what would you say is the best product in the market at the moment for buy-to-let investors?
It's a great question with a very difficult number of answers, I would probably say. The reason being is that I'd be looking at a couple of different things to assess before saying what is the best product for any client. Probably three things in particular. The first one is going to be, what is that person's circumstances? Are they investing in a personal name? Is it in a limited company? Secondly, what type of property are they investing in? That's going to be a massive dictator in, what might be considered the best. And actually the third point, which some people maybe take a little bit more time to get their head around, is their actual appetite to risk, is a really important point. What type of returns are they looking for? What type of debt are they willing to take on? And what type of investment are they looking to do? Is it something that might be a little bit more hands-off or something that's a bit more involved with works? The best rates and the best deals, it very much comes down to how much money you want to put in and how much it's going to cost. If we're more focused now on the buy-to-let space, we start from rates and products that have at the very lowest rate a 3% or so, which might surprise some people listening to this, that it's rates as low as that. Not everybody is applicable for those sorts of rates, and deposits as small as 15%. But that is for the smallest percentage of property investors in the UK, and certainly our international investors and global investors. You're looking at products that might be more akin to 4, 5, 6% interest rate, and a deposit of certainly greater than 25%.
Right, yeah, thank you very much. And what about interest-only products? Is this something that is available to investors? And what would you say are the pros and cons to going interest-only?
It absolutely is. It's a great product. It's actually our biggest suite of products for our buy-to-let investors. We've obviously got two sides of the spectrum, interest-only and repayment mortgages. To clarify exactly what that is, interest only is where you are just simply paying back the interest accrued on that mortgage every single month for the term of the mortgage. Repayment, you'd be paying back some of the capital that has been taken out as part of the debt. The pros and cons, I'll start with the con. There's only one major con, and that is regardless for how long you have the mortgage and how much you pay off, you are going to have at least the same amount, if not a little bit more with fees added, to repay at the end of the mortgage or when you look to exit that property. So if you're an investor who can get your head around the fact that you're not actually paying back the debt or the capital of the debt that you've taken on at the outset, then the pros of it, an interest-only mortgage, certainly much outweigh, from an investor's point of view, a repayment strategy. The number one reason that we always get, my team and our broker team would have conversations akin to this with all of our clients, is what are you looking to do? The biggest one for investors is I want to create some margin every month. I've got a mortgage payment and I've got rent that's coming in and I want to maximise that as much as possible. And in order to do that, the interest-only mortgages have a slightly smaller monthly payment. So that's the typical one that they'll go with.
Excellent, thank you. How is the rental income assessed when applying for a mortgage?
A great question, and it's a complex calculation, and I'll do my best to explain it in the most simplistic terms, because unhelpfully all lenders assess rental income slightly differently. Now, it's probably the most misunderstood part of the buy-to-let mortgage is the impact that a particular rent can have on what you can borrow, and the impact on a deal stacking up for an investor, for an agent, and actually a lender as well who's willing to lend. So what a lender will do is they will ask a valuer to go out to a property, and they'll ask them actually two things. Can you make a valuation of what you think the property is worth? And actually, can you make an assessment based on local comparables as well of what rental income is realistic? From that rental income, there's actually a complex calculation that lenders will do that allows them to assess how much they will borrow, lend rather, against that particular property. That calculation, as I said, every lender's is slightly different, but I'll give you a very simplistic way of calculating
Thank
it.
you.
Okay, so if you take a gross annual income of rent for a property, divide it by 125%, and divide it by the pay rate of a mortgage, let's say it's 5% in this instance, you will actually be given a cash value. To actually give the maths on that, using that calculation on £1,500 a month rent, you're going to be able to borrow about £280,000, just over.
Right.
And that calculation is used, and variations of that calculation are used. It's probably worth mentioning very slightly, and I suspect it will come on to a few additional questions further down the line around, is that calculation always the same, and when does it change? That calculation changes on two distinct areas within a project. It's the lenders dictating what is it around the pay rate and the mortgage rate and the calculation there. And actually, it's, are you buying a personal name or a limited company? Ordinarily, buying a limited company gives you a slightly more generous calculation. Yep. So on the maths that I gave you to say that you might be able to borrow 288,000, I think it is, on £1,500 a month rent, that's reduced by about 14 or 15% on a net loan basis if you actually take the mortgage out in a personal name, because they stress test it slightly differently. That's the key phrase.
Yeah, of course. And what about if the rents change, if they're buying off plan, or when they get close to it, what do the rents change before then?
Yeah, absolutely. Up, a positive; down, not so good. And the reality is that we have to wait. And everybody's becoming very accurate now. ERE and agents alike, we're all familiar with what the market is. You experienced in selling that type of property in stock, and actually the predictions of what a property is worth and the rental income that it might attract is always very, very good. But typically, the lender is always going to take a surveyor's, what they would describe as objective and RICS valued view on, firstly a property value, but also a rental income as well. So it can go up, it can go down. Not as many ups as there are downs, but we try and get pretty close first time of asking. But all that will do is it will have a slight impact on, can you borrow as much as you think, based on the value of the property and the calculation that I explained a little bit before.
Yeah. At the moment, one of the good things is that the rental market is quite strong, and people that are already in renting, people own the house and they're looking to remortgage, they are finding that the rent they're getting now is a lot more than when they first got their mortgage.
Absolutely,
so that does help when they come to remortgage, doesn't it? Which is quite good.
Yeah, it really does. And we're in a really exciting time now in 2025 where we were just talking very quickly beforehand about how the market has changed. We're not where we were 2 or 3 years ago, which saw inflation, increasing mortgage rates, rental stagnation and house price stagnation. We're actually seeing quite the opposite of all those things now, powered by some wage inflation as well. Rents are going up, house prices are going up, and we're actually seeing that base rate come down and dragging the mortgage rates down amongst a few other factors, which is great.
It's all quite positive at the moment.
It is quite positive.
We're finding that with a lot of clients at the moment, that they're definitely feeling a lot more positive about the market now than they were a couple of years ago.
Sure.
So what about the fees then that are associated with taking out a mortgage, the broker fees and et cetera? What should our investors expect in that regard? Yeah,
I mean, there's a few absolute dead certs that come in a certain chronology. In the most part, there's usually an application fee with our specialist lenders of a couple £100 to put the application forward to them. Following that and through a process of credit and underwriting teams, we get valuation fees as well before a surveyor is going to go out. Should a successful offer come back, there will be a broker fee. And of course, when the mortgage is taken out, there's typically fees of between 2 and 5% at the moment is the norm. There are product fees that go onto the loan. They're not paid up front, they're added to the loan. But if you redeem that loan at any point, you are going to pay those back. But that's typically the type of fees we see in the buy-to-let space at this moment in time.
So to our investors that are listening at the moment, that almost sounds like a lot of fees and quite scary, but it's not quite the extreme as it sounds, sort of a fee here and a fee there. They're not as bad as, it's not thousands, is it, that they end up finding themselves in?
It's not at all. And I think based on the investments that we know we're talking about and the assets that we're talking about for our clients and our mutual clients, is property has changed over the years. It's not a short-term game anymore. If you look at it that I'm going to be in and out of this project in 1, 2 or 3 years, some of the fees might feel a little bit steep and they might be a barrier to entry. But actually, if people are looking at it for a longer term, 15, 20 plus years, and it might be for a retirement plan or inheritance purposes, actually when you start to extrapolate fees that are there and that can't really be avoided over that period of time.
We all wish we could, but
yeah,
can't be avoided.
They can't be avoided. And you know, it's one of those things that if it can't be avoided, how do we mitigate it? And we mitigate it by attempting to put people in the most cost-effective solution as possible, really, and getting them the greatest return on investment. And there's still opportunities to do that. Slightly different ways of doing that, I would certainly add, from maybe 10 or 15 years ago. But property is still an absolute leading asset class in the UK, and I don't think that will change.
Yeah. And what about portfolio mortgages? Do lenders look favourably towards those, or do they still offer portfolio mortgages for people that are wanting to buy multiple properties?
They do. And we see it from time to time in DNA that portfolio mortgages are suitable. What I would caveat is that a lot of the time, and as part of the research that any good broker would do, is yes, to look at lenders who will offer products that will cover multiple properties owned by a particular individual or their limited company, but actually to go and look at other areas of the market, because not all lenders offer that. Right. Lenders have exposure limit on individual clients. They have the exposure limits on certain types of property. They have exposure limits on certain geographies around a city or a district or a postcode. So actually what you do find is that sometimes to mitigate a few of those fees that we might have talked about, a portfolio product might be the right course of action. But actually sometimes you'll find that multiple and separate applications to different lenders based on a company, its director and its owner, and actually the property that we're looking to finance against, you might find there's some more bespoke lenders that we can look to compartmentalise the portfolio for, again, looking for all those 1%ers to find margins to try and squeeze a little bit more out of the portfolio. So to answer your question directly, yes, portfolio mortgages do absolutely exist. But the big challenge is not all lenders offer them, and that's not always the right solution for the client. But a decent broker can
And I
work
guess
that
that's
out.
the advantage of working with a good broker, that they can, rather than having to apply to lots of different lenders yourself, they can put you in the right direction.
A very difficult thing to try and broker yourself. Many of the lenders that offer that are going to be intermediary only anyway, so you're going to have to find a broker to find those sorts of deals. But I would argue it should be part of any broker's, let's say, repertoire, that they should be able to go and look at different lenders and look at different products that are out there. Yeah,
that's lovely. Thank you. So what are the benefits? Earlier on today, you've talked quite a few times about people that buy as an individual or they buy now as a limited company.
Sure.
What would you say the benefits are of buying in a limited company, and how do the mortgages on offer differ between a limited company and an individual?
Yeah, this has been a question that we've got more and more in the last few years. The reason it's become about more and more is there's been a particular push from the UK government, if nothing else, but economic and political parties to try and professionalise, I suppose is probably the right way of putting it, the landlord space, the investor space. For a long period of time, the last 20 or 30 years, accidental landlords have come about in, leaps and bounds really for the UK space. And to be honest, what it has done is it's created a huge disparity between people who know how to be a landlord, want to be a landlord, how do the property stock that is on the market, and actually how does that affect the availability of housing in a country that we have a so-called housing crisis and a shortage of houses. So what we're starting to see is what I would probably describe as some fairly penal rules and regulations that are coming into play. And I would focus on people buying a personal name to begin with. For a long, long period of time, certainly since 2000, financially, most, if not all, the benefits have been slowly taken away. And at times, big chunks of that have been taken away. You're taxed to a far greater extent at the very top line, owning a property in your personal name. Section 24, if anyone wants to go away and read that, is a piece of tax legislation around how you are taxed in your personal name, and property income does fall under that. I won't go into the devil of the detail of that because we might be here all day talking about it, but actually it's made it fairly unattractive for most people to invest in their personal name. Of course, speak to a tax specialist. DNA aren't a tax specialist, but we refer clients and we have preferred partners who are, because it is a very specialist angle, but I think it's important for brokers to at least get an understanding of what the options are, why people invest in a personal name and a limited company, because ultimately we're working with lenders who often have slightly different products for personal name and limited company lending. The major things to consider are, at the end of the day, when you've got income coming in and expenses going out, how can you tax efficiently structure yourself? And also, when you're actually trying to get into an investment, what is the most effective way and efficient way of getting into an investment? I mentioned previously around rental stress testing and how that is slightly different between personal name and limited company. Arguably, in most scenarios, you are going to have find a slightly larger deposit to invest in a personal name than you are in a limited company. I would argue, and I have done this, arguing in a limited company is just much more professional and structured. And I think that's what everyone should be doing now. We should be, this isn't really a hobby. The accidental landlord I think have been and gone now for those making decent amounts of money from it. And I think you have to look at things in a slightly more structured way. We know running our businesses that you put it in a limited company or LLP, very few, and it would be a rather small business to trade out of your personal name. And I think that's the general direction of the property space now and the property investment space now.
That's definitely what we're finding. A lot of our investors now are setting up a limited company before they buy their next purchase or even their first purchase.
Sure.
And some of them are even transferring their portfolios from their individual names into their limited company. There are obviously sort of tax implications in that, but we are finding more people now are getting wise to that and are setting it up in a limited company name. A little bit more paperwork at the beginning, but definitely there's an advantage later on.
Yeah, I would completely agree.
Yeah. So another question we've got is that you mentioned the Section 24 mortgages. Obviously, like I say, you're not a tax specialist, but what are the tax benefits? Do you know much about that particular mortgage?
Yeah, I mean, the benefits of Section 24, well, they're quite limited to not being many benefits, actually.
Yeah.
From a tax implication in a personal name, it's really rather penal now. You're pretty much taxed at the top level of the gross income and your gross rental income. There are very few deductions you can actually make that you can make, or you can make equivalent deductions if you are investing via a limited company. So there are typical expenses and typical deductions that you can take away. That is one of the sweeping changes that's been around for the last 5 years or so, and is becoming more penal, I suppose, to investors. But tax and regulatory changes are, I mean, they're ongoing all the time. The biggest ones we've seen in April 2025 are actually in the stamp duty space, and that is a hot topic of conversation for investors. Rightly so, because it's gone up a little bit for everybody.
Yes.
Investors are a little bit upset about the implications of stamp duty, but actually many of those thresholds to buy a residential property have become less favourable as well. So it's not just a grab at landlords. I'd argue there are some policies out there that have been a grab at landlords and to wean out the ones who maybe are a little bit unsure on the fence. But actually the tax implications, regulatory implications, they are wholesale on the stamp duty front. There's another regulation I'd probably touch on that's going to come. Should have come variously in 2025 and 2027, and that is to do with EPC changes. So EPC changes look to be coming into play in around 2030, but the government really knows that the impact on landlords and the cost of doing a lot of these improvement works that they've asked for existing property in particular, is such a barrier. The cost of them is such a barrier that really many landlords either can't or won't do them. There's lots of grants out there you can do, whether that's room and roof insulation, boilers, heat pumps, and everything in between. There's lots of opportunities out there for landlords to improve property. I think it's generally a good thing, but actually when you're asking landlords and investors to find £20,000-30,000 per property per portfolio, it can be quite a challenge. And I think 2030 we'll be lucky to hit that. I don't think it'll be a severe cut-off date, but that's a super pertinent regulatory change that everyone should be aware of. The final one is the Renters' Rights Bill, which is less definitive in when it's going to come into play. I know there's huge conversations that are happening at the top level of government to try and find the right direction and the right route. Everything I've seen so far is it probably sits on a fence. It hugely misunderstands tenants and it hugely misunderstands landlords to the point where it doesn't really benefit anybody, and you might be better just standing still and continuing with the processes and the regulations that we've got. But keeping tenants who are good, pay rent on time, and actually I think if rents can rise generally in line with CPI and inflation, then we should be in a fairly healthy place. We haven't been in a healthy place, I don't think, in the private rented sector. Certainly 12-month ASTs, assured short hold tenancies, which really are they make up the lifeblood of the private rented sector in the UK. The landlords have really struggled to make them work financially for a couple of years because of the mortgage rates that we've probably talked about, that have now changed. I think they work again. I was one of those landlords it didn't really work for the last 2 or 3 years. Yeah. But it does work again. So there's lots of regulation. Keeping on top of it is really important. But also as well, if you're investing for your future, sometimes, look, it's not risk-free. It's quite the opposite of risk-free at times. But there's certainly some crazier ones out there. Sometimes you just have to bite the bullet and you have to get in and get stuck in. And, would you rather look back and say 5-10 years ago, I should have done that and should have just, muddled through a couple of these regulatory changes? Or is there an element of confidence and bravery that should really come into this space?
If you just stand steady, eventually it does go up. And
it does.
Yeah, it's always the best time to get in is a few years ago. So get in now and let it grow is always the way.
I would agree.
So I know a lot of our listeners and a lot of our clients do often ask, we've got all these costs, how can I save some money? Do I really need to take out mortgage protection insurance and landlord's insurance, and what are the benefits? What would your advice to our investors be on mortgage protection and landlord's insurance?
Yeah, it's a hugely varied topic, and we see a number of different approaches that landlords and investors take. Some take it directly based on, let's look at this as a business cost and a business venture, and I'm protecting any sort of liability that I might have with my mortgage debt. But actually we find that people who are typically now investing in property, it's not the only thing they've got going on. They'll have assets behind the scenes, they might have a family, children, and other things to protect and look after. And actually the complexities around what were to happen to me if something, if I were to be hit by a bus or to die or to become critically ill, actually there's so many things that go into play here that the conversation around insurance for our investors now extends far beyond just protecting the mortgage that you've got, but actually, does it protect the life that got you to a stage where it allowed you to invest? And does it allow you to be that entrepreneur and that property investor for the future as well? So we always hugely encourage having a conversation with an insurance advisor to make sure that you've got all bases covered. That could be absolutely the properties you've got now, the ones you want to buy, but actually, what is your legacy going to provide as well? Because there are some clever strategies, some inheritance tax planning strategies that insurance in some circumstances can be really effective for. So, we see lots of benefit to investors, particularly in the UK. The options are a little bit more limited for investors that are based overseas, but UK investors buying UK property, there's a huge opportunity to make sure you're covered and protected.
Yeah, that's great. Thank you. Obviously, you've already mentioned today, and we were having a conversation earlier outside about interest rates and how they, the heydays of the 1.25% obviously have gone and the interest rates have gone up. And then thankfully in May, interest rates have come back down again. But landlords are always asking about interest rates and how that will affect them and what protection do they have. It's a big question. It's always a worry on people's minds. What if interest rates massively go up again? What do you tend to say to your clients in regards to protecting themselves from interest rates and rising interest rates?
Yeah, protection's a really tricky word to use on this topic, because there is no protection at all, if I'm being perfectly honest with you. But that's not to say that the market is necessarily as volatile as we see in the news and in the media. There are rates changing all the time. I would say that maybe 3 years ago, protection was really something that you'd have liked to see. We'd have liked some protection from what was about to come. But all of the markers that we have from our lenders, from the Bank of England, from all the think tanks in the UK right now about where mortgage rates are going, where the Bank of England base rate is going, and all the various debt and financial transactions and policies behind the scenes around gilt yields, around swap rates, and how actually the financial markets in the UK are positioned and priced, is that we're looking at potentially another 1% off the base rate over the next 12 to 18 months. And I think that really strongly prices mortgages in a really downward trajectory for maybe the next 2 or 3 years. I'd really like to see that after 2 or 3 years, we take another view and we take a look at where the market might be. If I'm honest, I hope not in my lifetime, that might be a slightly strong phrase, but I don't think we go back to the levels we saw 3 years ago, or 2.5 years ago, where much of the buy-to-let space was at 6, 7 and 8%, even for UK investors. Because what actually happened at the end of 2022 was a huge shock to the market that should have gently crept in from late 2019 and into 2020. There was a little problem called COVID that happened that meant actually a lot of fiscal policy that should have changed over those years didn't. We appeased huge amounts of the market. We had stamp duty holidays. We actually had an even greater push for people to borrow more, to have even greater financial breaks, to take on greater debt with no real penalty in terms of interest rates. And it's really fueled the idea that for the last 10, maybe even 20 years, where interest rates have been very, very low, cost of borrowing has been very, very low, education around money management has been quite poor as well. We have created a generation of people who've been really quite fortunate with borrowing money at very low prices. So I actually think there's a big problem with borrowing money at almost zero cost, because I don't think it's great for the education side of things. And actually where we got to was just a reaction to financial changes that should have happened 2 or 3 years before. And it was the shock that the market maybe needed, if I'm being completely honest with you, because I think it's a healthier market if we've got mortgage rates at 3 and 4%, if you can put money in the bank and save at 5 and 6%, and all these other things that the UK property industry has always thrived on, which is house price growth and rental growth driven by wage inflation. These things are always there. And I think if we can maintain this kind of cadence and this speed that we're moving at now, it's the first time in a long time we've seen such positivity and such energy in our market. We're going to be in a really positive position.
Yeah, thank you. So you mentioned earlier on about obviously the insurance for overseas investors being a little bit harder to get. How do lenders view overseas investors or expats? Is there still as good a market for them as there are for the investors that are based in the UK?
There really is. There really is. It is a different set of lenders in the most part. It's a different set of products. If you are an international investor, I mean, you're categorised by that based on your passport status. In essence, that's the easiest way to break it down. You'd be considered a foreign national. They are entitled to one suite of products. Our expat clients who have a British passport but are based overseas are entitled to a slightly different set of products. Right. And that is, of course, different to our UK-based investors and property purchasers. So there is 3 categories. Mm-hmm. There are lenders who will do all of those 3 categories of buyer. Many of them actually specialise in one or the other. And the product prices, the product rates are slightly different based on, I'm careful with my language, perceived risk. I think it's a slightly strange approach from lenders still. And I would hark back to the idea that we're encouraging people to be professional investors and landlords. We want them to invest in a limited company. I would argue that an investor based in Singapore who is mandated to be a director of a UK-based limited company to invest in property with a UK bank account is of not much greater risk investing in that property than somebody who's based in the northwest of the UK, who does the same thing as a director of a limited company, and vice versa. So I've actually had some great conversations with the lenders. There are a couple of very specialist lenders out there who price a singular pricing based on personal name or limited company, and irrespective of is it a UK national, foreign national or expat within. But most do have separate pricing. I actually think that'll be an area where the market will change in the years to come for the reasons I mentioned.
And does that work the same then for people that are expats living in the UK? So someone from America that's an expat in the UK at the moment wanting to buy UK property. So their passport obviously is an American passport. How would they be viewed?
Yeah, it's expat. It is expat. And it's worth caveating as well. A lot of the work we see is through limited companies across all those different types of clients. 75% of the ownership of the limited company will dictate what product you are entitled to. Right. If there's 4 directors, 3 of them are living overseas without a UK passport and the 4th is a UK national, you will be getting international rates. That's a question that we see sometimes, so it's just worth clarifying these little nuances and these little things that we see. Of course,
I'm sure people try and avoid, find a loophole and think, well, I'll open a UK limited company even though I'm from overseas and think that might exonerate them on the mortgages. So it is a really interesting point for people to be aware of.
Absolutely, yeah.
One of the big things that's around at the moment is Airbnb, short-term lets. We're moving a little bit away from it. At one point, lots of developers were saying, yep, you can get short-term lets in my development, no problem. And now some of the larger developers are saying, no, they don't really want short-term lets. But there still is a real appetite for short-term lets in the market and Airbnb-style rentals. How do mortgage lenders look at that? How do they view that, people with Airbnb?
In the specialist space, there are lots of options. Lots of options, though, doesn't mean that everybody looks at it in the same light. And I'll give a few examples of the different ways in which people consider the likes of Airbnb or putting it on booking.com and all these different ways, or going through a holiday let agency. The first thing to get everyone to get their head around is that how it is calculated on affordability, and we talked about rental stress test earlier and the rental income, is there are some lenders that will take holiday let equivalent figures, high, mid and low season figures, and they will work out an affordability calculation based on that. Actually, the majority of lenders, regardless of how you're going to let the property, if you tell them it's going to be a holiday let or a short-term let, you get a specific set of pricing, and it's actually initially assessed on affordability based on a single 12-month AST rental figure.
Right.
And that's what the surveyor will go out and do. Regardless of what you then do once you get the keys, you can obviously go and, if you've got the right mortgage product and approval to do it from the scheme itself and the site itself, you can go and rent that property how you like. But actually how much you can borrow and the rates you are entitled to are sometimes quite different. So there's a myriad of lenders, if I'm honest with you, in the specialist lender space, who will do the naming of convention of this space is quite tricky between serviced accommodation, holiday lets, short-term lets. Everyone names it slightly differently. And the maths behind it of what you can afford, how much you can borrow, and what rent is taken into consideration. They're all slightly different things. But actually, we still say it in certain areas as a really effective and strong way of increasing those rental yields that we've talked about, that over time have not stayed as strong in certain asset classes and in certain investment opportunities as they were maybe 5-10 years ago. The short-term let space has really come good.
And do lenders ever add restrictions onto the mortgage offer then? So if you've taken out the mortgage for your apartment but on an AST, and then a year later they move out and you think, I'm going to do Airbnb, do you need to let your lender know, or do any of them add restrictions that say you can't do that?
Most of them do add a restriction.
Right.
So the mortgage that you take it out for should be the purpose that you use it for, at least until you exit that mortgage with a refinancing after the end of the fixed period, or if there's an exit strategy in place. There are some lenders where you can go back to them and look for it and seek approval. The unfortunate reality is many investors, they don't ask the right questions and they invalidate their mortgage terms and conditions. There isn't a huge, I suppose, set of examples of people who have, have the rule book thrown at them for doing these sorts of things. But it's really something that people need to be cautious of. Those huge documents that we get with our mortgages that everybody's supposed to read through, and arguably, do they have the time or do they actually understand what they're getting involved in? We'd like to think they do. But reading through these extensive documents and understanding what the restrictions might be, I'd argue it's on your professional advisors, a broker included, to say, we are signing up for either a typical buy-to-let 12-month AST mortgage here, or this allows you to do holiday lets, serviced accommodation and short-term accommodation, and beyond, social housing, commercial, whatever it might be.
Yeah.
It's up to your professional team around you to give you some of that guidance. But there needs to be accountability for the person investing, that I've got to understand what I'm getting involved in here. And we see lots of that. We see lots of people who, let's say, 3 years or 5 years down the line from buying on a 12-month AST, actually, to make the maths work and continue for the investment to work, they need to change things. They'll go back to the lender. We often find actually it does coincide sometimes with a refinance, and people are looking to pull out some money anyway. So there's always a will and there's a way.
It's always best to read the small print.
Read the small print,
yes,
that'd be great.
Indeed. So one of the big questions that people like to know is, if they buy their apartment, and everyone's always hoping they're going to get a good return on the investment and some capital growth, if they're still within their fixed term, but they know that their asset has already gone up in value, can they refinance to draw some more money out, even though they're in the fixed term of the current mortgage?
Yeah, they certainly can. The only thing to be considerate of is what would be called ERCs, or early repayment charges. Right. Again, every lender ordinarily has their own set of specific early repayment charge templates, I think is the right way of describing it. Generally, let's say we used a 5-year fixed term, and at the end of that fixed term, you went on to what a lender would describe as their standard variable rate, usually a much higher rate above the Bank of England base rate. We often see investors that are refinancing at the point of expiry to pull out some equity from that 5 years worth of capital growth and go back onto a product that is we hope, of an equivalent mortgage rate or even less, and your monthly payments reduce. The ERCs on something like that would typically be 5, 4, 3, 2, 1. 5% in the first year, 4% in the second, 3% in the third, and on we go until you get to the end date of that fixed term is when there's no early repayment charges. So up to the final day of that first 5 years, you could be entitled to a small percentage penalty for exiting that. But often we find if there is an investor who's hugely enthusiastic to refinance before the end of their fixed term, there's usually two reasons for it. They know that there's significant property values that they can pull some equity out of to do with what they want, or they know that there's improved mortgage rates out there, and actually any early repayment charge will be more than mitigated by moving on to a different product with hopefully a lower, usually interest-only fee.
Thank you. Now, also, there's something that I only came across very recently, this top slicing, of people wanting to use their personal money to sort of top up and top slice against their mortgage. Can you explain to the people that have never heard of it, like I hadn't until recently, what that means and how it works, please?
Yeah, of course I can. So top slicing is a mechanism of when we go through the process of assessing affordability on a property. And it goes down to the rental stress testing in the most part that we discussed earlier in the calculation for doing that. Let's say you have a property that is valued at £200,000 and you want to borrow 75% of the value of that property, £150,000. If you find that there is a shortfall in the calculation we did earlier on the rent and getting to 150,000, let's say that there's a figure in there, I don't know off the top of my head what that figure would be, but let's say you've got rent that's at £700 and that gets you only to 120 or £130,000. In order to make that shortfall up, rather than you just putting a greater deposit in, what some lenders are able to do is do what's called top slicing. Now, an even more boring and mathematical calculation is involved in top slicing that is even more individual to every lender, but they will start to look at your personal income. They will start to do a calculation based on your personal income. That would be payslips, PAYE payslips, or additionally, they might start to look at dividends or drawings if you're a company director, but that's another level of complexity. But what it can allow is you to just top up that last little bit. What it doesn't allow you to do is typically go over the standard loan to value caps that we have in the buy-to-let space. Very little buy-to-let work is now done with a deposit less than 25%. Or 75% loan. What top slicing won't do is you get 75% and then you get another 15% to reduce the deposit. It's really to get you from, if you found yourself in a position where you're at 50 or 60% loan to value and you think, I haven't really got the money or I wouldn't like to put the money in, can I find another 10, 15% from elsewhere? They'll take your personal income. They're going to ask for some more documents. Not all our investors are able or willing to show those documentation when they're trying to invest in a particular way. But if you can and you're willing and you do have a job that pays, and it's even better if it pays handsomely, you might be able to borrow more. And what it actually just allows is you to put a little bit less in at the time of buying.
So when people are applying for a buy-to-let mortgage, is it always just based on the value of the property and the rental income and means testing it that way? Or does it ever take into account their means test and their affordability and their income?
It certainly does buying in a personal name. Like I said before, the lion's share of our work in a limited company, as many lenders now don't have a minimum income requirement as do. The ones that do have a minimum income requirement, typically it's anything from £15,000 to £25,000. And we find that 99% of our investors more than comfortably cover that from their own personal circumstances. But we're seeing more and more now, and I think this is a sign of how professional the space is becoming, that the lenders, they're not really interested in that person's personal financial circumstances. They're really interested in, can you be the director of a limited company? Can you get an accountant? Can you do your books? And can you run a professional organisation? And be a good landlord as well. But actually what they're really interested in saying is, what does this property value at? What rent comes in? And does it comfortably cover the mortgage? If it does those things, they feel really comfortable. They're getting an interest payment that is their profit and their money, and the investor is getting a property to put a tenant in and for them to make hopefully the investment and the margin that they require as well. So there's a few things at play, but we're seeing some great success in that type of investing at this moment.
Excellent. Well, thank you, Hugh. There's a lot of very interesting information that you've shared with us today. So finally then, just one last question would be, what advice would you give to new investors that are looking for a mortgage product, or even at the moment, maybe just looking for their first investment before they move on to find the mortgage that will work for it? What would be your top advice that you would give them?
Yeah, it's really to get educated and, to find out as much as possible from any means possible. Speak to other investors, speak to agents. Google is a great place to start, but has its limitations, of course. But get professional advice, and you need to have a little power team around you. You need to find a mortgage broker that you can work with really well, a solicitor that you can get on with, and that's going to work in your interests. If it's not already provided by a lender, find somebody that can do that, and an accountant that you can take advice from, and tax advice. It might be the same, or it might be a separate representative that does that, so that you can actually turn up and have a conversation when a great opportunity presents itself. You're not the only person going for it. You've got to have a CV of your own to say, whether this is my first investment or my 15th, I've got to present myself in the best way here to be able to buy that property, to get a good mortgage on it, to hopefully get eventually a really solid tenant in there, and then over time to be able to run what we see in the most part is a professional operation of being a landlord now, to make a profitable entity of it. And it's not profit at all costs, but if you're providing a service, I believe that there should be some money in there to do that, and everybody can win, because I think you can then maintain a property in the correct way. A tenant can have a great place to live and a secure property in that instance. So it's really about just asking the right questions, whether that's a question because you're based overseas, whether that's a question because you don't know if you're investing in a personal name or a limited company, whether that's about deposit and how much deposit you should really have. That's maybe the biggest one right now is, do you actually have enough cash? Because do you actually know how much it costs to get into property? Yeah. Because having a 25% deposit is probably not quite enough in the most part now. 30 to 35% really makes me much more comfortable when clients speak to DNA and speak to my team and they've got 35% instead of 25%. There's some wiggle room there. And I would say that, it isn't cheap to get into. It's certainly not free to get into, and it's not a given that you make lots of money straight away. In some circumstances, the strategy requires you to stay in it for many, many years. But that is the way that the way the industry is going. That's the way the market's going. And I think it's really important for investors to recognise that being educated, being up to speed about what is going on in the property market right now, and taking as much advice as possible is a great place to start. But actually, that you've got to be in this for the long run, and you've got to do it in a proper way. It's not get rich quick, it's quite the opposite. Yeah. That would be my advice for anybody who has invested before. It still stands true, and I'm sure people would look back if they have invested already. Would they have done things slightly differently? Are they glad they did things in a certain way? I'm sure there's many examples of that being the case. But for people who are getting into it and are new into it, it's really, there's no stupid questions, and ask much more than you probably think is necessary.
And so what about people that are looking at off-plan at the moment? So they're not going to be putting in their mortgage application maybe for another 18 months.
Sure.
Would they still be best to speak to someone from DNA Finance before they put down their reservation and start paying their deposit, just to get an understanding of what to expect when they come to complete?
Absolutely. We do that exact process right now every single day. That's slightly different to many other brokers. So we have what we would describe as a financial qualification team, our client services team, which is different to our broker team. And our financial qualification team are really there to reassure people who are not buying today. They might be buying in as little as 6 months, but maybe we've even had conversations of 3 or 4 years' time. Granted, there's a little bit of finger in the wind. There's predictions about where the mortgage market might be, but we've been in this game long enough to recognise, where the market might be going and the trajectory of things. But we will certainly have a conversation to highlight and point out to any investors things that they should be aware of if they're buying off plan, let's say in 18 months' time. The process that goes on between now and then, when to start re-engaging with hopefully DNA as a broker to get things ready and lined up, because 18 months sounds like a long period of time. It might take quite a long time to get there, but when it comes to practical completion, buildings getting signed off, and completion notices going out, these things happen really quickly.
Very quickly, yeah.
Developers often work at a very different timescale to what we as brokers, lenders, and agents know is realistic, but we try and manage anybody's expectations. But yeah, as as of today, we carry out as many conversations in our business, which is reassuring clients of the options that might be available to them in the months and years ahead. We actually will be brave enough in certain circumstances to say, this isn't the right opportunity for you. We have a conversation with any agent partners and certainly the likes of ERE, who recognise the value in what DNA can provide, that we don't want to put people in the wrong property, in the wrong investment. And actually some people have financial circumstances that isn't suitable for property in general or off plan. But that is not the lion's share of cases. In most cases that we come across, as long as there's a healthy deposit there, we check some background financials, we look at the market and we look at the security and where we think things are going to be in the next 12, 18, 24 months. And we make an assessment. And we don't just sit on the fence either. You know, we'll give people, if they ask for it, what rates are now. We'll even give a prediction of what we think rates are going to be, because we are the most clued up. And when we don't know things, we're still going to be the most clued up of the people who don't know things, if that makes sense. So I really encourage my team, that's everyone from my business partners to everybody across the business, client services, brokers and case managers that work at DNA, to wear your heart on your sleeve, have confidence and conviction, to stay educated, because we certainly do know our stuff, and to provide an answer and provide a response. If somebody asks you today that I want to have a broker appointment now, can you give me it, even if it's not completely necessary? We'll try and answer those questions there and then, but at the end of the day, we're here to provide a service, and clients are absolutely pivotal to that. So yeah, we try and be as helpful as we possibly can.
That's lovely. Well, thank you very much. So anyone that is looking at the moment to apply for a mortgage or looking to invest, they're Hugh at DNA Financial Solutions, and you're based in Leeds, is that correct?
Yeah, we're based in West Yorkshire, so an office in West Yorkshire and an office in Lancashire as well.
Lovely.
But working with clients across the globe, investing in UK property.
Yeah. So thank you very much. Thank you for joining me. I really appreciate all of your information. Thank you very much. So thank you very much. This is Helen Mercer-Jones, Managing Director of E.R.E Property, and we look forward to our next podcast. Thank you.